we go. Oh, we got some people rolling in here.
We do. I see some familiar names. I don't know about you guys, but I am not ready for my kids to be home for the summer.
No, not at all.
I checked on my little ones at like lunchtime before poor Nanny, and they were just running wild.
Oh, I've got one of ours coming to the office actually tomorrow. He is bored at home, so I told him I'd put him to work.
Oh, nice.
Yeah. Are you hearing the notification sounds that I'm getting?
Not even. Oh, yep. Now I do.
Like that? Okay. I can't figure out how to turn that off here. We're just going to exit out of this completely. Hopefully that works. And let's see here. I am going to, looks like, can anybody type in the chat section? Can you see that chat section for those of you that are here right now? I guess you can't respond to me if you can't.
They passed the test.
Yeah. All right, well, then we will. There we go. I just turned it on. There we go. Okay. Perfect. Working now. Good. All right. So as you guys can probably see, anything that you're typing, hopefully you cannot see each other's, which means all questions will be anonymous. Feel free to ask away throughout this entire presentation. We want to try to address as many of these questions as we can. We do have a ton of questions that people have asked coming into today. So there's obviously a lot to go through. We'll just kind of go ahead and dig in. We've got we're about 2 minutes into this, but we've got quite a few people still rolling in. But we'll just go ahead and get started and kick this thing off. My name is Jamin Garabedian. I'm with Assurance Wealth Management. I'm the owner and founder here. We run a retirement planning firm. And today we are joined by Rachel Knapp, who is the managing partner at Ramdas Accounting. She's a CPA, CFP, MBA, very intelligent person. And she's going to help us with a lot of the most common tax questions that we get. We're going to go through some general strategies. Obviously, when it comes to taxes and accounting, there's so many things to go through that there's no way that we could cover it all in 1 hour. So we're going to try to get through as many of these common questions and strategies as possible. If we don't get to your questions during this presentation, we will reach out to you afterwards and answer any of them that we get in. Keep in mind, everybody, that this is informational only. This is educational only. Please do not take anything that you hear today and go off and run with it and try to implement it yourself. Please speak to a tax professional or your financial professional before you do anything. Nothing we are doing here is necessarily advice that you need to go take right now. It is just concepts and ideas for you to think about that may help you with your taxes in the future. So with all that said, Rachel, thank you for coming in.
Oh, thank you for having me. I'm excited. I know no one likes to talk about taxes, and it's always kind of a pain, but we're going to try and make this entertaining and fun.
We'll try to make it as fun as possible. I mean, last week, I know, Rachel, you were on last month, you were on our presentation with Don Henderson, the estate planning attorney, and very similar estate planning and taxes. It's not stuff that anybody really wants to, go talk about, and it's not something you think about as fun, but it's very, very important information when you're thinking about your financial future. So
right. There's that famous saying of there's nothing certain in life except for death and taxes. So,
and that's what we're starting our year. That's what we're starting our year of webinars off with. Is first death and now taxes. So here we go. Well, the presentation title, as everybody sees, and a lot of you came in for, is tax preparation versus tax planning. So that's kind of where I want to start is, what are the main differences? What is tax preparation versus what is tax planning, and why is why may tax planning be just as important, if not more important, than the actual preparation of your taxes?
Sure. So tax preparation, you have to kind of think about is your year in review and taking all your tax data and dumping it onto a tax return. Tax planning is more of the present and the future. And if you do the tax planning correctly, that data dump on your tax return isn't as painful, or at least you're aware of how painful it'll be. And so we want to think of tax planning also as part of the financial planning process. I mean, because you're not going to be able to accumulate wealth or preserve that wealth without some really good tax planning strategies included in there. Whether that be estimating out your income, projecting Roth conversions, estimating taxes quarter by quarter due to capital gains, even things like strategizing IRMA thresholds or Obamacare thresholds when you're in those kind of situations. And the tax laws, I'm going to show you guys. This is our tax code. As I think we pointed out, it's about 6,700 pages long. If you add in regulations and things, it's about 75,000 pages long. So taxes are not a very black and white area. They are very subjective. ChatGPT actually passed the bar exam on its first try, but it failed the CPA exam on its first try. I'm not going to say that we're smarter than attorneys, but most people that can't pass the CPA exam do become attorneys. So,
oh no, I'm not going to want to hear that.
But yes, so that's basically the difference between planning and preparation. In planning, you do want to lean more on the certified individuals, whether they be a CPA, a CFP, an enrolled agent. And I'm going to say CFP in there just because I know tax planning is, like I said, part of the financial planning process. And so you guys do have a little background in tax as a result of that.
Sure. And a lot of the tax planning portion, I mean, would you say that it's just as important for individuals and families as it is for business owners? Because we see a lot of things on the internet about business owners being able to do all these write-offs and deductions and great ways of saving taxes and strategies for business owners. But is tax planning just as important for individuals and families? Do they have as many strategies that they can use?
They do. A lot of times more circle around what options they have regarding like health insurances and retirement planning strategies. And then we look too for estate planning strategies that all come back to tax, because in the end, everything comes back to tax and no one wants to pay those tax dollars.
Yeah. And so let's split this up. Let's try to split this up. We'll split this into first, we'll kind of go into some of the small business and business owner type questions and strategies that we've gotten. And then we also go into the individuals and families questions and strategies that we've talked about in the past between you and I. And then we've got a number of questions, a lot of questions here that we had come in before this presentation. So we're going to try to address as many of these as possible. Again, we're going to try to go through our portion of it in 30 or 45 minutes, and then we're going to open this thing up to Q&A. But feel free while we're going through this, everybody just ask whatever questions come to mind, and we will answer them as we go if they're relevant to what we're currently talking about. If not, we will get to them towards the end. But on the small business side of things, you see it all over the internet that there's so many different strategies. I mean, there's the YouTube tax specialists and the TikTok tax specialists and all these different things that we see. How accurate are a lot of those? I mean, how legal are a lot of those?
A lot of them are pretty sketchy. And I love it that my clients are comfortable enough to send me some of these videos and ask me if it's a true state strategy. And a lot of times I'm like, please don't do that. That's tax fraud. But yeah, I mean, I think the latest one I received was how to write off your dog on your taxes if you're a small business owner. And it was basically trying to say that the dog is a security guard. And yeah, don't do that. But yeah, so small businesses, there are more opportunities for things that are kind of more personal assets to be able to write off. I mean, the big ones are usually like home office and vehicle, cell phone use, and then you can kind of strategize different retirement options that work for you and work for your cash flow. To get into like kind of the small businesses, I always tell people first, if you're looking to start one, get with an attorney. First off, because we want to look at legal protection from a get-go. I mean, whether it's going to be just a sole proprietorship where you're doing business as, or a DBA, limited liability company, LLC, there's limited partnerships, there's Inc., which can be S or C. We'll get into that in just a second. But once you decide what the legal protection is that you want, and a lot of it comes down to what business assets are being withheld in the company and things like that, or if it's just a consulting firm, then from there, we kind of determine what tax strategy we want to go with. There are certain ones that, like LP, limited partnership, you have to be a partnership. There's no getting around that one, or a general partnership. But things like the LLC, you can be a disregarded entity, which means it's disregarded for tax purposes and reported straight onto your individual return. You can be an S corporation, which is a pass-through entity, meaning that the net profit of your business passes through the business entity to you individually. And then there's the C corporation, which is its own taxable entity at that point. And then again, we look at the tax strategies between all of them and kind of, again, what's your end game on what you're going to do with the assets or with the business itself. Are you looking to sell within 10 years? Are you looking just to kind of keep this going for until you retire? And we decide what your tax structure should be from there. But yes, going back to the various deductions, I mean, the home office one is the easiest if you have a sole proprietorship. But again, you have to have a profit in order to do the home office deduction. And you can depreciate your home, but then it comes back when you sell your home. So there's always, I like to say, the law of physics of every action is an equal and opposite reaction. That's the same with taxes. If it's a deduction somewhere, it's income somewhere else. So we always kind of keep that in mind of, okay, where are we moving money pocket from one to the other?
And so does this all also work? I mean, when people think of business owners, they're thinking of, corporate structures and they're thinking of big businesses. But does this also work for people that may have had their career, now they're retired, and maybe they like doing woodwork on the side and they want to start selling some of their woodwork, or they like, staining glasses, or they have these little hobbies that they want to turn into maybe a little small business? Would you advise people that are selling kind of anything or doing Mary Kay or any of that kind of stuff when they're retired, to look at some of these tax planning strategies around small business owners?
I do. And for a liability protection as well, that's why we tend to go with an LLC as the most common small business structure, because of the flexibility and the protection. In Texas, I think we are ranked right now as number 7 as the most LLC friendly state in the nation.
Okay. And kind of going into that side of things is people tend to start businesses just to start a business, just so that they can get some write-offs, whether it's a true business or not. And a lot of the TikTok advice, we'll just keep calling it that, even though it's, may not have been on TikTok. It could have been anywhere on the internet, but is, hey, I can write off, or I can get deductions for, hiring my kids, or, do I pay my spouse or not pay my spouse? Those types of things. How would you, I guess, advise people to consider what is a business and what's not a business?
So a business, it's all about the intent. So if your intent is for profit, you have a business. If it's more of, I'm just doing this for fun, it's a hobby. We run into hobby loss issues. Even when it's a for-profit and you're running a loss, which means your deductions outweigh your income, you don't want to run a loss for over 3 years, because then you become a high risk for an audit, and you become high risk for the IRS coming back and saying, hey, this is a hobby, this isn't a business. But so those are things that we want to look out for. Paying your kids, I swear, is the best tax loophole out there. Because there have been so many court cases about it, and they always tend to favor the taxpayer in it. And so as long as you put your kid to work in some sort of business purpose, whether it be putting your 2-year-old to work scrubbing baseboards, or you put your teenager to work moving furniture and, painting the new office, you can still pay them. And certain business structures like the DBA, or the sole owner of the LLC, where it's straight onto your tax return, you can actually avoid payroll taxes on the child if they're under 18 and pay them straight the wage. And so it becomes a deduction for you. And if they're under the standard deduction themselves from that wage, then they do not have to file their own tax return. They do not have to pay income tax on it at all. And so it becomes a big win when you can pay your kids.
So it's kind of safe to say that if you're trying to reduce taxes, whether you're retired or maybe you have a W-2 job, if you have any hobbies that you enjoy doing, maybe look at ways of monetizing those hobbies and turning it into a small business. Is that fair to say?
That is.
Okay. Now, once you've had your small business, or maybe you haven't, either way, but you want to now sell it, and you're looking at retirement, you're looking towards retirement. How does the sale of the business get taxed? Are there strategies around certain ways to sell the business to reduce your taxes? I mean, what does that look like?
So we want to look at what type of sale it's going to be when it's a business. There's kind of 2 different types. There's an equity buyout, which is buying the company completely. And then there's an asset sale. The asset sale is more beneficial for the buyer and less beneficial for the seller. And the reason why is differences between ordinary income and capital gains income. The tax rates are quite a bit different. So your ordinary income, the highest tax is 37%. The capital gains, the highest is going to be 20%. If you're subject to net investment income tax, there's an extra 3.8%. So at most 23.8%. Big difference there. And the reason the asset sale, sometimes if you're buying like a customer list, that is ordinary income because that revenue generated ordinary income for that business. Now, when you do the equity buyout and you buy the whole company, you're selling your equity, which equity is a capital asset. And so that becomes more beneficial for the seller. But again, because the asset buyout basically gives a step up in basis to the buyer, and then they can depreciate or amortize some of these assets, it's more beneficial for them to go that route. And so you kind of have to negotiate. And some people too, they want to hold on to the business name. Maybe they want to just hold on for it for sentimental value, or maybe they're going to switch industries or do something that's not within their non-compete agreement. And so it kind of goes case by case on that situation. On top of that, I mean, we can do installment sales, which kind of break up your tax. So basically you just get paid like a monthly amount or an annual amount, and your overall gain is broken up throughout the years of this installment sale. There's also the qualified small business sale exclusion, or qualified small business stock exclusion, which a lot of people That's another TikTok one that a lot of people hear about, but there's very specific criteria for that. For one, it has to be a C corporation. So no S corporations, no disregard entities, no partnerships. And with that, you have to be the original shareholder, and you can exclude, if you're under the revenue and under the asset limit, you can exclude, I think it's up to $10 million right now of capital gain from the sale of that stock. But again, very specific criteria that has to be met. So a lot of medical technology companies are going that route, or joint venture capitalists are going that route, because their end game is to basically sell in 7 to 10 years and exclude all that gain.
Okay. That's a lot. That's a lot.
I've had some clients do it. It's amazing.
Yeah.
I love it for them.
And so have you dealt with, because this is something I've seen a lot recently, or heard through my networks recently, is the deferred sales trust. And have you dealt a lot with those? Are those good, bad, indifferent, case by case? Kind of what are your thoughts on deferred sales trusts?
They are gaining in popularity. I saw one maybe 5-6 years ago, but it was actually pretty small. But basically, they put the asset within a trust. Per Internal Revenue Guidelines, transactions between a grantor trust and an individual and the owner of that grantor trust are tax-free transactions. However, grantor trust, the income and such are reported onto the individual. So it kind of comes back. But what a lot of people are doing is it's the first sales trust. So the asset is sold to the trust. The trust enters into an installment agreement with the grantor, and we break up that trust, and we basically keep renewing an installment agreement with that. And so we just keep doing a little bit of a chunk while that money is growing within that grantor trust.
Gotcha. So it's a way of doing the installment sale, but allowing those assets to grow within the trust while it's the seller is getting their installments.
Yes, it has to be set up correctly from the get-go. And so again, an attorney like Don Henderson could set that up, but there are a million other little strategies that work for specific arenas, and that is one of them.
Okay. So kind of all these different strategies are basically a case by case, like whatever your specific situation, whatever you are trying to do, whatever your end goal is, there's probably a different strategy for each one of them.
Exactly. And then with tax planning, I mean, that is something that we look at. Like, okay, I'm looking at selling this asset, this piece of land in like 5 years. Okay, let's go ahead and move that asset into this trust. In 5 years, you sell that land, and then you start this default. Gosh, I can't talk. Deferred sales trust agreement. Gotcha. And we start recognizing the capital gain little by little while we're still letting that money grow within the trust. That way, too, when you pass away, it goes to your beneficiaries.
Gotcha. Okay. So now we've been a business owner, or we started a business. We've sold our business. We are now kind of in the retirement state. When it comes to all the different accounts that you've set up during your working years, your IRAs, your 401ks, your Roths, your taxable brokerage accounts, all these different things, they're all taxed in different ways. So I guess kind of the textbook way of distributing all those assets has always been from, you'll see in a lot of CFP courses and whatnot, it's been the taxable, tax deferred, tax free, kind of the textbook way of doing things. And most advisors advise that. But there's better ways for tax purposes. I mean, that is around the idea of growth, right? You want to be in your tax deferred and tax free as long as possible from a growth standpoint. But from a tax standpoint, is that necessarily the best way to distribute your assets?
Not always. And a lot of it comes down to just the prediction of how the tax rates are going. A lot of retirees feel like they're going to be in a much lower tax bracket come their retirement years. And based on how assets grow, based on the way tax brackets change and tax laws change, a lot of them end up paying more in taxes on that tax deferred income that they put away during their working years than what they're doing in the retirement years. And so we try to kind of strategize between pulling out the assets that are like in your taxable brokerage account, and you know, that appreciation is now kind of not necessarily tax-free. We have capital gains, but again, capital gains rates are lower than ordinary income rates. And so then we look at doing Roth conversions, trying to move pre-tax money over to the after-tax money before RMDs hit, because again, with inflation, appreciation, those RMDs are very hurtful during those retirement years. And so a lot of people, luckily, you know, Secure Act 2.0 had increased retirement age from 72 to 73. But before that, it was 72. And before that, it was 70 and a half for the longest time. So a lot of people, due to the longevity of everybody's lives kind of increasing, those now IRAs, those 401ks, those pre-tax are coming back to bite everyone in the butt.
Yeah. And one of the things that I've seen a lot, because we do work with a number of retirees, is they've saved all this money in IRA type accounts and in tax deferred type accounts. And now they get to the age where they're having to take RMDs. Well, they're also taking Social Security at that time, not realizing that those RMD, the size of the RMDs that they're having to take is now forcing their Social Security to get taxed at the highest level. Mm-hmm. So how does the breakup of Social Security, how does Social Security get taxed, and how does where you're pulling money from affect that tax on Social Security?
Sure. So at the highest, Social Security is 85% taxable. Those levels are dependent on your modified adjusted gross income. So modified adjusted gross income, everyone's pretty familiar with adjusted gross income. That's literally a line on your tax return that says adjusted gross income. Modified will bring back in your tax exempt interest and little things like that you originally didn't pay tax on. And so a lot of people, especially in those retirement years, switch their investment strategy to bonds. That way they're preserving their wealth. But the bonds right now are paying out very well because of the high interest rate. So then that tax exempt interest comes back in. Social Security rises. On top of your RMDs, which now, since the market's high, RMDs are going to be higher, again, comes back. All of those combined equal to your modified adjusted gross income. And then on top of that, if you become over the IRMA thresholds, then you're paying more Medicare premiums as well. And so, like I said, those RMDs are kind of a problem these days. And so we are looking to mitigate those RMDs, whether it be through qualified charitable distributions, Roth conversions, just different ways that we can try and strategize, even within the investments themselves, are trying to kind of stall that growth in the years that the market's taking up. Because again, that means market's up, means RMDs are up. So
that's kind of where you were talking about earlier, where a good financial plan ties in with your good tax plan to overall reduce taxes, but possibly increase your wealth, increase your income, but lower your taxes, is kind of tying the two plans together.
Right, exactly. And I kind of wanted to point out some of our tax brackets. So right now, the 2024 top bracket for filing jointly is about $730,000, and that's 37%. Back in 2017, prior to tax reform that hit in 2018, the top bracket was 39.6% at $470,000.
Oh, wow.
So $300,000 more was taxed at a higher bracket. And then back before that was 2012 at 35% for $388,000. And I just kind of want to point out that tax reform from 2018 is set to expire January 1st of 26. So it's supposed to revert back to that 39.6% level, unless they do something about it. But we won't get into politics right now.
I mean, printing $7 trillion might have something to do with
it. It might a little bit.
And for clarification purposes, because I get this a lot when I talk to people about their Social Security tax, when she said that the highest tax rate on Social Security is 85%, that doesn't mean your Social Security is getting taxed at 85%. That means 85% of your Social Security income is taxable. Those are Two completely different things. Because I have people say to me, hold on, you're going to take away 85% of my Social Security? No, that just means 85% of that income is taxable. Okay.
Yes.
So
Thank you for that clarification.
Get that cleared up, because I get that a lot when we talk to people about it. So, well, and you mentioned Roth conversions and how that's a big strategy right now. Because we are in lower tax brackets than we've been in a long time, do you see now as a great time to do as much in Roth conversions as possible, just kind of assuming that tax brackets are just going to continue to rise from here?
Even if they don't rise and they stay the same, I still recommend Roth conversions, because if you can get assets that grow tax-free and come out tax-free, oh man, you're winning. And on top of that, for the estate planning purpose, I want to point out too, the inherited IRA rules that changed with Secure Act 2.0, which also apply to 401ks. But basically, if say you're the last to die of your spouse, your children or nephews, nieces, or whoever, non-spousal, inherit your retirement plan. They have to take out that money within 10 years. Right now, the IRS has been saying, oh, they have their own RMD, but they don't know what that RMD level is. Again, other issues, but we'll digress. But if they're having to pull out $100,000, say they're in their peak of their working years and they're in the 37% bracket. I mean, that's $37,000 they're losing to taxes because you kept it in the IRA instead of moving it over to a Roth IRA. If they pull now Roth IRAs, they still have the 10-year rule, but again, it comes out tax-free to your beneficiaries. And so you have to also look at these retirement accounts as your estate planning tool, if you want to leave anyone money. Otherwise, spend it and have fun.
and kind of along those lines is a lot of the people that I speak with have significant income during their working years. And so they actually made too much money to make any Roth contributions. So in their mind, Roth conversions is something they've either never heard of or didn't think that was allowed because they weren't allowed to do Roth contributions. Can you explain the difference of those high income earners, what is allowed and what isn't allowed when it comes to contributions, and the difference between that and conversions?
Sure. So the contributions are based on an income level. So you can do within a traditional IRA, you can do what's called deductible contributions and non-deductible contributions. You can do deductible contributions if you're under a certain threshold, or if you're not covered by a retirement plan and you have earned income. Earned income is working income. So salary, self-employment income, those are earned income. So from there, those are your two options for your IRA. The Roth IRA has an income threshold as well. So if you're over that, you can't contribute no matter what. So we kind of run into, okay, can we do a backdoor Roth IRA? Because that's another TikTok video a lot of people hear about. And the way the backdoor Roth IRA works is you put money into a non-deductible traditional IRA, and basically the next day you roll it over to a Roth IRA. Non-deductible IRAs, if you're putting money into it, the basis comes out tax-free. The earnings and the growth are what are taxable. So there's a pro rata share when you do that. So if you put it in $6,000 one day and you next day roll it to the Roth IRA, that basis didn't earn any money. That basis didn't grow anything. So that basis comes out tax-free and you roll it to the Roth, because even if you're a higher income earner, you can roll to a Roth from a retirement plan.
So anybody can do a Roth conversion. Not anybody can do a Roth conversion.
Yes. And the backdoor IRA only works if you don't have an IRA in place already. So kind of keep that in mind as well, because a lot of people are like, oh, backdoor Roth it. I'm like, it doesn't work if you already had an IRA set up and that has money in it, because the IRS looks at all your IRAs as one. So all traditional IRAs are one, all Roth IRAs are one. Doesn't matter, and they're in different accounts. But the Roth conversions are basically moving your money over from that traditional IRA. So even the ones that had the pre-tax contributions into it, not the deductible ones that we call, plus the earnings and the growth. And you pay taxes on it now, but you roll it to the Roth with the intent of it continuing to grow and accumulate. And we want to do that in the years that we are in a lower tax bracket. So I like to call them the early retirement years, where maybe Social Security hasn't kicked in, RMDs haven't kicked in, but we also want to time it between your IRMA thresholds, and we want to time it to where we don't go over certain tax brackets as well. The 24% bracket is the main one that a lot of advisors stick to. After the 24% bracket, it jumps to 32%. So no one wants to go over the 24% bracket.
And again, for clarification there, if you're at that top of the 24% bracket and say you go over it by $2,000, that's not taxing the entire amount 32%, correct? It's just
right.
taxing the amount that you went over. So
right. Our tax brackets are cumulative. So it's like a chunk at 0, chunk at 10, 15, yada, yada, yada.
Correct. And so, yeah, because I hear a lot of people that are so freaked out by doing a conversion that they're anticipating an amount that they need to convert to stay at 24, and they go over by $1,000 or a couple $100, and then now they think that everything's going to be taxed at 32%. It's not that nuance.
No.
I was like, you can go over by a couple $100 and you're just fine. Your taxes aren't going to be that big of a difference. But okay, so as far as kind of our travel, our path that we've gone on from owning our business or starting our business or small business and then selling it. Now we're retired and we've gone through some of the strategies there. What would you say are just some, we've gone over Roth conversions, a lot of others, but what would you say just some general strategies are that you think fit for most everybody? Are there any strategies out there that you're just like, hey, you need to look at this? I mean, is it itemizing versus standard deductions or the other way around? Is, kind of what ideas do you have out there just for the blanket?
My first one is just estimating your taxes throughout the year. And the reason why I say that is because a lot of times people find themselves between the different kind of equity awards through their regular job, whether it be restricted stock units or bonuses. A lot of companies now they have switched to doing those type of compensation at a flat withholding rate. And it's usually like 20%, even though they may be in the 35% bracket for their salary, which then causes this big dip and discrepancy in their withholding. And so then they are very surprised at tax time that, hey, I owe $50,000. Why do I owe $50,000? And I can point out right away, it's usually that. And so I like to tell people, run an estimate. Either have a CPA do it or a tax professional, because they can also implement some different what if we mix things up a little bit situations. The IRS on their website has a great withholding calculator that you can run an estimate through just to kind of see if you're doing things correctly. And at the end, if it tells you owe this amount of money or you're going to get this large refund, it'll give you a pre-filled W-4 to submit to your employer to basically change up your withholding to what your target is. But again, you need to know what you're doing on that, of how to put in the correct income, because if you have other income going on, it may not be the most accurate thing. So yes, so usually I do say, talk to a tax professional about just estimating out how you're going to be doing through the year. On top of that, general strategies, I always tell people, is it more important now to pay the taxes or pay later? And if they want to pay the taxes now, we look at doing Roth options, because a lot of employers have Roth 401k options. And so instead of doing a traditional 401k where you're taking that pre-tax deduction now, you can do the Roth 401k and get that after-tax effect that we were just talking about with the Roth IRAs. It's the same premise.
Gotcha. Now, okay, we've gone through, we had our business, we sold our business, we're retirees, we got some blanket ideas. Let's tie in, our third piece of our little trifecta we tend to work on with our clients, and that's the estate planning or Dawn side of things. So what from a tax side should people be worried about or planning on from an estate tax standpoint? What are things that they can do to kind of mitigate estate taxes? I mean, right now, the estate tax exemption is so high that a lot of people don't really concern themselves with it, not thinking about the fact that, look, it's probably not going to be that high for very much longer. Most likely. I mean, the Congress has been talking about bringing it down for quite some time. So what are things that you recommend for people for estate tax purposes, whether it be a trust or anything else, that they can do to try to mitigate some of the effects of when they pass away? what their estate or what their beneficiaries are going to have to pay in taxes.
Right. Gifting is a big one. And a lot of people believe that gifting is taxable, and it's not. So as long as you stay under an annual exclusion, which I believe this year it's at $18,000. So you can gift up to $18,000 a person. So husband and wife times that by 2. So you can gift your son or your daughter, what is that, $36,000 tax-free. You don't even have to file a gift tax report. Now, if you give them $40,000, you're going to have to file a gift tax report to report that excess, and that $4,000 is going to be subject to gift tax. But again, that lifetime exemption that Dawn touched on last month, which is roughly like $12.5 million per person, kicks in. So you take your taxable gifts, you take your estate at the fair market value of your estate at your date of death. If that's going to be under that $12 million threshold, you're fine. You're not going to be subject to any of these estate tax. The problem that we're all having right now for planning purposes is that limit is set to expire January 1st, 26. And it's supposed to go back down to about $5.5 million. So right now is still a good time. Everyone still should be planning. And like I said, there's a great book out called Die with Zero. I think you have a guest coming on next month about the book. But it does talk about spending your money now and try and die with zero net worth as much as possible. When that's basically go ahead and gift the money now. Go ahead and use up some of that exemption now. But I try and tell people, let's look at this from where your net worth is, where it might go down to for the exemption. And we try and strategize between that. And we wait and see, okay, what's going to happen with this exemption level? Is it going to go up? Is it going to go down? Is it going to stay the same? And we can readjust every year as a result of that. But again, there's certain accounts too that aren't included in your estate. And that's why we try to roll those over to specific accounts like the Roth.
Well, perfect. Thank you. It was a lot. It was very informative, and we've kind of gone through the path that I kind of wanted to go with you and get those questions, because those are a lot of the main concerns that I hear from a financial planning side of things is, how do we save money when the business is? How do we save money when we sell our business? How do we save money in retirement? And then the estate planning side of things. So I want to thank you for going through all of that with us. That was awesome.
Of course.
And now I've got, if you're ready for this, first of all, I'll open this up for anybody to start asking questions. I got 2 of them already in here, but you guys go ahead and start asking all the questions that you've got over anything we discussed or anything else that you've got out there, and we will try to get to those. But I've got a nice litany of other questions that have come in before this presentation for you. So let's start digging through these and see what we can try to help some people out with.
Well, I see the first one's about TurboTax.
Yes. Yeah. And that was one of the questions we actually got prior to this, and we also got while in this, is why a CPA? Why not just TurboTax or, one of the other auto tax accountants out there?
So TurboTax is fine for the very, very simple one. So maybe you have your Social Security and you have your RMD, and that's it. You have 2 forms to put in. You don't itemize. That's it. But even with that, you still have strategies that you could be missing out by using a CPA. And so TurboTax too, it still relies on humans. So we have to keep that in mind, that tax preparation it's not all automated. You still have to put in those numbers, and those numbers, sometimes it's real easy to transpose them. And it's real easy to answer a question incorrectly on TurboTax. I had a friend the other year that called me up, and she was running her return through TurboTax, and she had a credit for $20,000. And she was like, I don't understand why I have this credit. So she gave me her return. I looked it over. She had added 2 extra zeros in retirement contributions, and TurboTax went with it, even though it was clearly impossible for that to happen. But that TurboTax was allowing it. So she would have gotten either audited by the IRS, or she would have been paid that money, and then the IRS would have come back, and give us back that money plus interest and penalty.
Yeah. That's not fun. The next one, let's see here. All right, this is a good one because this happens to everybody. Is what happens when you sell your home? What do taxes look like there?
Okay. So right now we do have a primary home sale exclusion. So there is if you're selling your home and it's been your primary home for at least 2 out of the last 5 years, a married couple can exclude up to $500,000 in capital gain. A single will be $250,000. So that means basically what you purchased your home for, add any big improvements or major repairs to it, add in the commissions and the closing costs for when you sold it. If that difference between the sales price is under the $500,000, there's no tax due. It's excluded. If you sell it for $600,000, $100,000 is going to be subject to capital gains, but that $500,000 is still there.
Gotcha. So we got one. Oh, this actually I get a lot. How is Social Security affected by government pensions? Well, I'll ask you a couple of questions here. I'll kind of expand on this one. So the question was, how does Social Security affected by WEP from other pension income? I will expand on that and say, how is it also affected by government retirement plans and also by foreign pensions?
Well, it all factors back into that modified adjusted gross income that we were talking about earlier. So income is income, whether it's tax-free or not, it's still considered income. And a lot of times these pensions, even like disability pensions that are kind of tax-free, do come back as part of modified adjusted gross income. Each one's a little different, so it just kind of depends on what type of pension it is. But a general standing of it is it's going to increase, it can increase your taxability of your Social Security benefits.
And so when you have a government pension, I mean, does it matter necessarily if it's, I mean, let me rewind. How do foreign pensions, we'll do that. We'll start there. How do foreign pensions affect Social Security? I guess from a tax point of view, and then also if you're aware does it deduct from your actual Social Security income?
Ooh. Well, we have to look so that can get into a whole other thing. So we look into, for those who don't know, the U.S. is a worldwide income tax. So that means any income earned anywhere in the world is taxable here. So it's not very friendly on that part. And so a lot of foreign pensions, again, depending how it is, because there's foreign government pensions, there's just foreign pensions. There's different tax treaties out there that sometimes can exclude them from income. But in general, most of the foreign pensions I've encountered, they are considered taxable income here on the United States, and that does increase your modified adjusted gross income. Now, benefit-wise, I'm not 100% sure on. I would probably outsource that one to a Social Security benefit specialist. I know can tell you how it's taxed, but not.
From a tax standpoint, it sounds like it's going to get taxed just like anything else, or just like any other pension. And as far as how it's going to affect your Social Security taxes, it's just like any other income. From a how much are you going to get reduced in Social Security, that is where we look at the windfall elimination provisions and stuff like that. That, you know, if you have questions on that, please reach out to me. We can go through that. Let's see here. The next one that I had was, let's see here. I don't have tons of money, so why do I need to do tax planning? Is it still important for somebody that is relatively moderate income and moderate assets?
Yes, it is. And I think I kind of answered that too with like the TurboTax. Even though it may be simple, we're looking at planning even when you become 90 and you're decrepit. Okay, do we have long-term care policies? Because then those kind of play into your taxes if you think about that, because there's per diem limits and things of that nature. So some of that may be taxable in the end. And so there are things, even if you think you are very simple, there may be things later down the road that may come back and get you and that you just didn't know because you didn't take the time to reach out and consider it.
Sure. Okay. we kind of went through this one. It's how can I reduce my taxable income? I'm assuming that they were looking about common ways of doing that, which we covered. What is the difference between a deduction and a credit, and how do I use those to reduce my taxes?
So a deduction, we tend to kind of more talk about the standard deduction or itemized deduction, which surprisingly I haven't talked about yet. So everyone is entitled to the standard deduction. It gets inflation adjusted. It's based on your filing status. If your itemized deduction, which we look at medical expenses, property taxes or state income taxes, sales tax, mortgage interest, investment interest, and charitable donations. If a combination of those plus the applicable limits, because there's a few things in there that have limits that what you can pick up is over the standard deduction, then you can itemize. So a lot of times we look at, okay, I have a year where I'm going to be larger income than normal because I've received a large bonus at the end of the year. How can I lower my taxable income? Well, big number one strategy would be a larger charitable contribution that year. And we can say we could pick out a church, we could pick out a 501c3. It has to be a 501c3, just so you guys know that one. Or we look at a donor advised fund, which is real fun to do. And Jamin, I know you are familiar with those as well. But a donor advised fund, you basically put money into this fund. You get the charity write-off in the year that you put the money into the fund, whether or not the fund paid out to a charity at that point. And so we do that a lot of times if it's very last minute, like, so, hey, December 24th, I received a $200,000 bonus. Okay, let's donate 40 grand more by December 31st into this donor advised fund. And boom, it's done. You have your charitable write-off.
Nice.
And then to answer the credit, the credits are a reduction of tax. So taxable income, we take our tax brackets and we do the math, the basic algebra to determine what your tax is on that taxable income. Tax credits reduce that tax number. And so there's quite a few different types of credits. Foreign tax credits, usually the number one because it comes from different investments, qualified dividends. Then there's residential energy credits that are a hot one right now. Solar panels, redoing your windows, insulation, all sorts of fun things like that. That was a big one Biden implemented in this past couple of years. On top of that, I mean, there's the child tax credit, the dependent care credit. You could get into refundable versus non-refundable. Most people incur non-refundable credits and not refundable credits because refundable credits tend to be more reserved for the lower income.
So the difference between the two is essentially a deduction will reduce your taxable income, but you will not get a return from deductions. And then the credits is what gets you your return. As if you have, I guess you get yourself into a point where your taxable income is down to zero and you have extra credits. That's when you get the return. Right.
So deductions are a percentage. They save you a percentage. So whatever bracket you're in. So like I said, if you're in the 37% bracket, you donate $100 to charity, it will save you $37 in tax. So it's not a dollar for dollar reduction.
Gotcha.
Credits are a dollar for dollar reduction.
Gotcha. Okay. And then the next one is, if I'm married, how does married filing jointly versus married filing single status affect my tax liability? Is there ever a time to use one over the other?
In very, very rare circumstances, it can save you a little bit of money, but not always. And usually when you see it working is usually when when you're kind of similar in tax brackets or similar in income, and you're right at that tipping edge of going into like a next bracket. So 24% to 32%. Okay, separately, we might both be in the 24%, but together we tip to the 32%. So we kind of switch it around and we do married filing separately. You do lose some deductions or some credits actually if you do married filing separately. So like the kids, dependent care benefit goes away if you file separately. Don't ask me why, but it does. But most times filing jointly is advantageous. And I know at my firm, we look each year We even run a scenario of, okay, what's their tax savings joint versus separately, and vice versa. And we run that scenario each time that we do a tax return, just in case there is a year where, hey, it actually makes more sense to go separate this year, so let's do it.
Gotcha. Okay. Yeah. So it sounds like you have to be in a very slim income level for that to make sense to go single versus filing joint.
Mm-hmm.
Okay.
And because Texas is in a community property state, we can actually shift income between spouses. So if we're in this weird conundrum where one spouse is really high up and another spouse is really low on income, we can actually shift some income to the lower end spouse to kind of maximize out the lower brackets and bring them down another bracket. So there are some strategies with it, but again, it's a very, very rare that you see it work out. Most people do married filing separately because of prenuptial agreements.
Gotcha. So here's actually a question from Don that he wanted you to cover from a tax standpoint that he talked about last month, which was, when is it appropriate to file an S corp?
Oh, goodness. So S corps are probably my favorite tax structure out there. And we look at different things because from an administrative standpoint, an S corp is more costly compared to the disregarded entity. There's reasonable compensation rules we have to work around for owners of S corps. And you have to file your own tax return for the S corp, things of those nature. So it becomes a little more trickier. There's just more work to it. However, it removes self-employment tax, which is 15.3% on top of your ordinary income tax. Usually at about $100,000 in profit is when it makes sense to switch over to an S corp. But you have to keep in mind that once you go S, if you can't go back to it. I mean, you can go back, but you can't go back and forth. So it's once you make it, it's it. You can revoke it, but you can't go back to it. And so we look at those when that becomes a savings. And then now we'll qualify business income deduction. And the way that the C corporation rate is, it actually becomes more advantageous to still stay an S corp when you become a higher level because of the mitigation of the excess Medicare tax that happens once you hit over $250,000. And on top of just the tax-free draws that come with an S corp. And so we run those scenarios. So we want to make sure. And the beauty too, an S election can be late. It can be late by 3 years and 75 days.
Oh, wow.
So if you decide maybe later, you're like, okay, let's do it. I should have done it last year. You can make that election, go back and file an old tax return and get that S election, those benefits. And so a lot of times when we're on that teetering point of going to the S, we purposely file the election late for that reason. So we have the best numbers and that way we know, hey, this is the time now to do it. We're over it. And so
kind of along that point, because I've been asked this before, is how far back can you go on your taxes to amend them? I mean, is there I can only go back 3 years to amend my taxes, or can you go back further? How far back can you go?
It's 3 years, and 3 years from the due date of those taxes. So kind of keep that in mind. So right now we're in May. So you can only go back 23 because 23 was technically due April 15th of 24, 22, and 21. So if you messed up in 2020, like you forgot, you should have missed, you missed the payout or something of those stimulus payments, you're done.
Yeah. Okay. We went through a little bit of when you should itemize versus standard deduction. Is there anything there that you want to, I guess, expound upon?
With retirees now, a lot of them with their homes are looking to remodel. I know I've had this question a couple of times from a few, and we look at maybe the benefit of pulling out a home equity loan. Even though the mortgage interest rate's there, you have the money to pay for it, but you also get the tax deduction on top of it. And so it sometimes makes sense a little bit to do a little bit of that just for the tax deduction.
Okay. And I know we're running up against the hour here. We're about 3 minutes to the hour. So I want to let everybody know that we told you it'd be an hour. So yeah, we're about 3 minutes away, but we still have a number of questions here. And as long as Rachel's got some time, I'm going to continue to fire some questions away at her. But if anybody has any specific questions or specific scenarios that you'd like to have reviewed to see if you're doing everything properly, and that's from a financial standpoint or financial planning standpoint or a tax planning standpoint, I'm going to put up a link here. Boom, there it is. There's a link there where you can schedule an appointment, a complimentary consultation. We will go through whatever it is that you need to talk about and figure out if there's anything that we can help either from a financial planning standpoint or from a tax planning standpoint. Go ahead and click on that where it says offers. There's a schedule now button. Schedule time that works for you, and we can go through whatever it is that you're looking for. So I wanted to let you guys know that before you jump off, because again, I know we told you an hour, but with our 75,000 pages of tax code, we've had a lot of questions. And so I'm going to keep firing away at Rachel until she tells me she's got to go. So we may go for a little bit longer if that's okay with you, Rachel.
Of course.
Okay. So I wanted to get that out of the way. But now we'll go on to the next one. We talked about, people say that the best way to save on taxes is open up a small business. I think we touched on that quite a bit as to why that is and all the deductions and strategies around a small business. I heard that Biden is talking about moving capital gains up to 44%. What should I do to reduce my capital gains tax? Should I sell before that happens?
Ooh, that's a good one. If I had a crystal ball for the future, I would be just like a billionaire at this point. But yes, the capital gain. So a big one there is working with your investment manager and doing loss harvesting. And I know Jabin does this towards the end of every year, is trying to mitigate some of those gains, especially if you have large ones, or using up if you had some carry forward of losses. Okay, well, then now's the year to go ahead and eat those up. Now, I will say with any kind of big tax reform change, it takes them probably about 2 years to actually implement it or even pass it. And so we kind of just pause for a minute. I know a lot of people kind of get worried with the talk of the higher taxes and everything, but again, it's not outlaw, and they will not reverse the tax brackets like that. Now, I say that, and they have a bill currently sitting in the Senate since March 21st about the 22 R&D credit and the 23 depreciation rates, but those are deductions. Those are not income brackets. So just kind of always take a breath when you hear about the increase in taxes, because it does take time. It takes a lot of debate up in the Senate and the House before anything can actually even pass and get written into law. And so that's something too that we work with. We watch like a hawk, and we work with, because if it looks like it's going to pass, then we will advise you of when to sell, and your investment manager will do the same thing.
So along the same routes, I've also had people with concerns of, I'm doing all these Roth conversions to save on taxes. You guys have talked about Roth conversions till you're blue in the face. We're doing them all. What's to say that because of our national debt and all that they don't change the laws in the future, that Roth IRAs now are taxable?
And that will be a new chess game. So they will always change things on us because they always want to collect more money because they like to spend money. Again, I tried not to be political, but I'm going to be a little political here. But they always change things. But there's always, for every Internal Revenue Code, there's probably about 5 exceptions to that code. And with those exceptions, there's probably 2 or 3 exceptions to those exceptions. And so a lot of times they will grandfather in, okay, you had a Roth in place already for the, maybe more than 5 years old. Okay, we'll leave it alone. It's the new Roths that we will go after. But with that, they're going to also there's going to be exceptions and that we will work around. The tax laws, like I said, they're very ambiguous. There's plenty of gray area to work in. And there's plenty of attorneys that are tax nerds as well that get into the nitty gritty and will fight it. So,
yeah. I'll say one of the things that I always tell everybody when it kind of comes to that, I wanted to hear from your side, the tax professional side of things, but one of the things that I always tell everybody when it comes to them taxing Roths is almost everything that politicians do and say is an attempt to get reelected. That's all they want. They just want to get reelected. If you take I don't know the number, I'm going to make one up, trillions of dollars that's in Roths right now, and all of a sudden just turn on a switch and say that that's all taxable, that's political suicide. They're never going to get reelected that way.
They're never going to get reelected. Yeah. I mean,
so I think
like
it's a very difficult thing to push through.
The most likely situation I see is it becoming new Roth accounts or new money going into it after a certain point, maybe taxable. But even then, it'll probably be an income threshold as well. That way they do help still the lesser income, or it doesn't hurt the retirees as much. But yeah, you're absolutely right. It would be complete suicide if they did like all of a sudden we're like, yeah, we're going to make it taxable. So
let's see here. If you have moved several times, does the 500K apply to each home?
There has to be a 2 out of 5 year period. And if you don't meet that 2 out of 5 year period and you have to move for a specific reason, like jobs. So you get relocated 3 states away. As long as you meet there's some exceptions to this rule is what I'm going to get at. But there's also pro rata of the rule. So if you're under the 2 years, okay, then maybe you did a year. So 50% of that 500K would be the excludable. 6 months, 25%. So yes, you can still do it. It just may be a little bit more complicated on getting that gain to come out correctly. And I will tell you, TurboTax gets it wrong all the time.
For those who are asking about TurboTax.
For those who yeah, that's usually the number one thing is I get someone that comes in with a notice from the IRS that says that their house sale was completely taxable. And it's because they did it wrong through TurboTax.
And for those wondering, Rachel is located in the Woodlands. She's actually right around the corner from us here in the Woodlands, Texas. But just like us, she does have a virtual office, meaning that she works with clients all across the country. So if you're in a different state, if you're not in Texas, unlike Don that we talked to last month, who is only licensed to do things in Texas, Rachel can help you with taxes all across the country. So anybody that's looking for help with their taxes, she is available to anybody. Let's see here. Let's go to the next question. What are estate and gift taxes and how do they work? We went through that quite a bit. All right. So those are kind of the general questions that people had asked. I want to dig into actually some of I'm assuming these are all TikTok strategies that people have heard. So let's try to figure out what's accurate and what's, for clicks. I've heard that I could deduct the full purchase price of my equipment in the first year for my business, even if I'm financing it. Is that true?
Not currently. Right now it's 80%. Actually, right now it's 60%. I take it back. 80% was 2023. So 60% is the bonus depreciation. Now, if your equipment is subject to Section 179, you can write off the first, all of it, even if you finance, as long as you purchase it. If you lease it, you are not entitled to depreciation. But financed, you can.
So what is Section 179? How's that different?
Section 179 applies to very specific equipment, and so you can write it off. But if you sell it within X amount of years, so with each type of asset has a useful life dictated by the IRS code. So say a computer, 5 years. So if you sell that computer within 5 years, you are going to have to reclaim some of that depreciation that you took in that first year. Okay. And that's going to be ordinary income. So it kind of comes back. So there's Section 179 and there's recapture. Okay. There's also bonus depreciation. And bonus depreciation is the 60% that I was talking about. That bill that I also talked about earlier about sitting in the Senate since March 21st retroactively moves bonus depreciation from 80% back to 100% for 2023 and would keep it 100% for 2024. The House passed it in January. It sat with the Senate and it has not moved and it is making my life miserable.
Oh, that's funny. What is a qualified business deduction?
Qualified business deduction is for small businesses. Roughly about 20% of your net profit is tax-free and becomes a deduction. Now, there's always some limitations to it, or there's different scenarios, and there's different industries that are not subject to it. So if you're in a professional services, we are not allowed to take that deduction. My physicians, veterinarians, investment managers, anyone that's kind of dubbed a person of reputation as your reason for business, even though architects and engineers and real estate agents still receive this deduction.
Oh, nice.
I know. How nice for them.
Yay me.
Yay.
We talked about this actually already. I hear online all the time about hiring my kids to save on taxes. Can you explain how it works and how you would structure that?
Sure. So if you're looking for, if it's a small business and it's a disregarded entity, you put them to work, document it, keep a little diary of what they're doing. There's kids of all ages that can work like this. There was a big court case. I know I told Jamin about this toy shop company that paid their baby, literally like a 6-month-old baby, up to the standard deduction. And the IRS came back and said, hey, you can't pay a baby. Like, what does the baby do? They literally set this baby in the middle of a room with a bunch of toys, and whatever toy that baby decided to go to, they would sell in their toy shop. And they were always the best sellers. So that was how they justified it. And and they won. But yeah, so you can put your kid to use. Like I said, they can scrub baseboards at 1 years old. The older kids can do more. You just kind of find a reason to put them to work. But I always say, don't pay over the standard deduction, because again, then they'll have to file a tax return. Then they'll be subject to some income tax. And depending on how you're structured for your business, you may not have to pay payroll taxes on them or unemployment tax, both state and federal. So it saves money all around. But there's different ways. And so we talk about it and we can justify it. There's different ways that we can justify it.
Are there any rules around, do they need to be W-2 or 1099? Is there a maximum? I mean, can you pay them a salary, or is it an hourly? And is there a max to that? Like, how do you structure that?
So the only way the strategy works is if you pay them a W-2, because if you pay them a 1099, even if it's, $600, they're still going to be subject to self-employment tax at that 15.3%. And so they still have to pay, they have to file a tax return then, you have to pay payroll taxes then, or you have to pay the self-employment tax. If it's a W-2, there's no self-employment tax. So you don't have to do any of that.
Gotcha. Okay. As a business owner, what is the best retirement plan I can set up to save the most on taxes?
We can get very into this one. I always say that the easiest one to set up is the SEP IRA. And that one's based off of self-employment income. And then if you switch to an S corporation, you can still do it. There's just some more caveats to it. But just for the basics, the SEP IRA is probably my favorite because of the ease. Because you have until you file your tax return to open and fund it. And that includes extensions. So if you're going to be contributing up to, the limit, which is about $65,000, $66,000, if you're making that much money, it is based off of your net profit. There is some little extra things, but I'll say roughly 20% of your profit is what you can contribute to a SEP. And so a lot of people, my clients, we look at cash flow. Okay, we're going to be depositing $65,000 into a SEP IRA, but we still have a, $30,000 tax bill we have to pay. So what we do is we extend the tax return. We pay the $30,000 at extension time. And we wait over the summer, closer to the fall, when money has come back in, and then we deposit that money into the SEP IRA. We can open it still by that time. It just has to be open and funded by the time that we file your tax return, which on extension is October 15th. And so that's the best way for that one. but we can also open solo 401ks. We can open regular 401ks. We can, oh gosh, simple IRAs is another easy one for small businesses. We run into issues with 401ks with small businesses because there are rules about highly compensated employees. And so especially like a lot of my physicians, where the physicians obviously out earning everybody else, but they're contributing the most, but because of a highly compensation rule, you can't. There's these tricky little ratios that you have to work around. And so we go to maybe a simple IRA. You may not be able to contribute as much compared to a 401k, but it allows that determination to the higher employees. So they can max it out and your employees can still put in the same amount of money basically because they weren't maxing out the 401k anyways. And so we look at different ways to kind of, what's the overall goal here? Do you want to be more fair to your employees? Do you want to max out everything to you? What do you want to do? We kind of look at what's your structure, because we have to follow that first off. And then we look at the wealth management strategy.
Yeah. And from the financial planning side of things, I know with that, has a lot to do with, do you have employees? Do you not have employees? Mm-hmm. Do you have 1099 workers? Do you not have, and, do you have a spouse that works for you? Or what is your end game? What is your goal here with funding these? So I think from a financial planning standpoint, and what sounds like from a tax planning standpoint, unfortunately, your answer is it depends. It depends on your situation because there's different strategies that are going to work for different people and different situations.
That was probably my favorite phrase as a professional is it depends.
I hate it because a lot of these questions that we get, a lot of these workshops that we do, we get a lot of questions that are very specific to somebody's situation. And the answer is almost always, it depends, because it depends. Your situation is different from the next person's. And so whether it be financial, estate, tax, it always depends on your situation, which is why, again, I can't emphasize this enough that today is all about education and about ideas. Don't go off and implement anything that we said today without speaking to a professional and making sure that it makes sense for your situation. Oh, no problem. Thank you for coming in. I just saw your statement there about you having to jump off. You are very welcome for this. And for everybody that came today, we will be sending this out as a recording to you so that way if you miss something or have any questions, we can always, get back to you on those. Lou, thanks for coming in. No problem. I'm sure I'll talk to you very soon. Let's see here. I hear all the time about deducting things like travel, vacations, and all I have to do is structure them as a work event. How does that work?
That's another TikTok strategy.
Yes. Go to Disneyland with your family and all of a sudden it's a big business write-off.
Yes. So it's completely fine to take these trips to a degree. I'm going to tell you what the IRS stands. You can do these. So you take a meeting one day and you take the other 6-7 days for a vacation. So you take a pro rata share of that one day compared to your total cost over that 6-7 days. And that is your business deduction. That is what the IRS states. Now, I will say for document purpose, because I will say travel and meals are the number one audits for small business. And it's because they want to know what's the justification for spending all that money. Document it. Like just have a little journal, write down what the purpose of that meeting was for, who you met with, the date, how long it lasted. That way you have that evidence there for them. Now, if you turn that meeting and it turns into 3 more days where you did more business stuff, then cool. Document that as well, and you can increase that pro rata share as well. So yes, it's all about the documenting and having a justification for it.
And there are a lot of rules and nuances that go around those. So please, before you do that.
Yes, and keep those receipts because the IRS will not accept credit card statements as your receipt. They want the actual physical receipt.
Yeah, I know from a personal standpoint, there are a lot of nuances and time limits and all of that kind of go into all of that, how long a meeting has to be or how long you have to be doing business while you're there. There's a lot of little things that go into that. So please, before you decide to go and do that, talk to a tax professional. Make sure that you are following those rules. Otherwise, you're going to have that entire Disney plan that you thought was a write-off not. Mark, yes, you will be getting invitations to all future webinars. Anybody that came to this, anybody that registered will continue to get invitations to our future webinars. I think Rachel's done a great job of sending them out to all of her people as well. Are these done monthly? Yes, that is the intent, is that we will have a different topic that's done every month. As a matter of fact, next month is going to be kind of around the idea of how to retire, what lifestyle that you want to retire with. And we haven't thought of a catchy little title for it yet, but it's something around, living in retirement and the ways. We're going to have our guest speaker is going to be the business partner of the guy who wrote the book that she talked about earlier, How to Die with Zero, because they've created some software and they've done a number of different things, educational events around the concepts and the conceptual changes in retirement of your lifestyle and how to live. And rather than the traditional model of save, pinch all your pennies during retirement so that you don't spend through everything, rather than that type of lifestyle, they want you to spend money. They want you to enjoy your retirement. They think of, if you die with $1 million, you died with $1 million worth of opportunities and memories that you could have had. So we're going to have them on next week or next month, and we will get you a date for that shortly. We're just trying to firm that up with them right now, but I think it should be great.
And Jamin, you continue to share these with me, and I will continue to send them to my clients as well. So
absolutely. Let's see here. What else do we have? We went through that. Oh, are there any specific tax strategies for people that are 65 years of age and older?
The biggest one is trying to stay under the IRMA threshold. That way we don't have a rise in the Medicare cost. Because, as you're retired, you have a budget, you have usually a fixed income. So those are things that we try to mitigate for you. On top of that, we're also looking at those Roth conversions for you, because usually that's when you're in the lower brackets, is between the 62 to 73, that decade. If you're not working during those periods, those are the lower tax bracket years that we try to maximize out for you.
Perfect. Looks like we only really have one more. Well, we talked a lot about this, about the charitable, the donor advised fund and some charitable giving and stuff like that. So what is the difference between like qualified charitable distributions? And then I know that I talk to my clients a lot about charitable remainder trusts. Where do those fit in, and how can those help from tax perspective?
Sure. So a qualified charitable distribution is taking money from your qualified retirement account, so like your IRA, and your custodian will send it directly to a charity of your choosing. And we do this because it skips your income. It skips your modified adjusted gross income. It skips your taxable income. It's the best way kind of to, if I'm going to donate, I might as well just do it this way. That way I get the complete, there's none of the income is there. And so we have several clients that do that every year because their RMDs are so outrageous that we're like, okay, let's go ahead and do the QCD for short, for $50,000 to $75,000 a year. And it ends up saving them quite a bit of money. Now, make sure it has to go from IRA to charity, and it has to be a 501c3 charity. It cannot go to the IRA to you and then to charity. Then it's an itemized deduction if you can itemize.
So can it go from a IRA to a donor advised fund?
I believe it. Can it? That I'm not 100%
Yes. In an hour and a half, I finally got one you didn't know. My understanding is that it can, because the donor advised fund is just a pass-through to the charity. So my understanding is that it can, but I'm not 100%, and I'm going to leave that one on you. I'm going to leave that one on you.
One that stumped both of us.
Charitable remainder trusts. Mm-hmm. How do they work?
So charitable remainder trust, you're going to put in usually highly appreciated assets. So usually usually investments is what it comes down to. The net present value of those, or no, sorry, there's a calculation for the remainder interest. Mm-hmm. The remaining interest of those assets, it becomes your charitable write-off the year that you form that trust and fund it. Now, I will say that the income that it generates, either you could do it as a charitable annuity trust where you receive a chunk each year from the trust, or you do it as basically unit trust, which then the income comes to you. So from the investments. And so you're still paying tax on the income from these assets up until your death. And at your death, whatever is left within those assets passes on to the charity that you had designated. And it's a great way to remove money from your estate, especially if you're going to be subject to the estate tax. That's the purpose of it, is to get it out of your estate.
Sure. And last one that I've got, unless we get any more that come in, is when I was working, I had an HSA. Is this something I can still contribute to once I retire?
Only if you're still part of a high deductible plan.
Okay. So if you get a personal high deductible plan, then you can still do it.
Yeah. So a lot of retirees too, before they hit the Medicare age, people try to go on COBRA. But if we're going to be down and we're not drawing on our IRA accounts, or we're not drawing on our 401ks, we're just living off our investment accounts. I actually tried to promote Obamacare a little bit, because you can get basically very, very cheap insurance and good insurance if we stay under a certain income threshold. And so then we start timing your capital gains a bit more for that reason. And so I have some clients that it saved them, $20,000, $30,000 a year by doing that method. And then once they hit Medicare, they'll go on Medicare, and we don't have to worry about it as much. But yeah, it's a big difference between IRMA threshold and Obamacare threshold.
Perfect. Well, we made it through. We made it through. Thank you very much. We got a lot of great information, I think. Hopefully this was informative for everybody that was on here. Again, I don't think we can stress enough that partnering up your tax planning with your financial planning, with your estate planning, is very, very important to make sure that they're all working together. I'm sure Rachel's seen this, where it's difficult for her to put a tax plan together and then have somebody's financial advisor just doing something completely off the wall different than what her tax plan is, and it just throws everything off, and vice versa. I mean, and I'm sure that, it's just something that all needs to work together. And so I'd advise anybody out there who isn't working with a tax professional, have a meeting with Rachel. Just see what she has to offer. See if it's something that's going to work for you. If you don't have a financial professional, or they're not working with your CPA currently, I'd love to sit down and talk to you. Again, kind of the third part of our little triangle is the estate planning attorney, Don Henderson. Whether you're in Texas or not, he will still have a conversation with you and talk to you about what you may need to put in place. And it's good to have as many people on your team as possible that are working together rather than siloing off and working separately. So Thank you, everybody, for coming. Rachel, thank you for coming especially.
Thank you.
And I have a feeling that because we went an hour and a half and we probably still didn't answer a lot of questions, we may do this again in a couple of months.
Oh, gosh. See it again.
If we can get some more questions answered. But thank you again for coming. Again, everybody that registered or that attended, we will send you out the recording of this. And if you have any questions, feel free to go ahead and schedule an appointment with us. We've got a consultation button there for you that you can schedule something on your own time that works for you. And just make sure to put in the notes that you're trying to talk to either Rachel or myself or both, and we can make that happen.
Definitely.
So, thanks again. And Rachel, I will talk to you soon.
All right. Sounds good.
Right. Bye.
Bye.